Did you know that every single day, trillions of dollars are traded in the stock market? But here's the twist. A big chunk of this money isn't even used to buy or sell stocks directly. Welcome to the amazing world of options trading, a place where people can make money by guessing what stock prices will do, without owning any actual shares. And guess what? We also have a free guide on options trading that goes perfectly with this video. We'll tell you how to get it later on, but first, hit that like button. It really helps us keep making helpful videos like this one. So, what is options trading anyway? It's when people buy or sell contracts called options. These give them the right, but not the duty, to buy or sell something, like a stock, for a set price. Within a set time. Think of it like getting a voucher to buy your favorite gadget at a sale price before a certain date. If the price of that gadget goes up, your voucher is super valuable. If it goes down, no problem, you're not forced to use it. Let's break down the must-know terms now. A call option means you can buy a stock later for a certain price. Imagine a smartphone is coming out next month. You pay a small fee today to lock in the current price, even if it becomes super popular and the price jumps later. Say a tech stock is now at $100. You buy a call option with a strike price of $105, paying a $3 premium. If the stock rises to $120, you can still buy it for $105. That's a good deal. But if the stock drops instead, you only lose the $3 you paid. A put option lets you sell a stock later at a set price. Let's say you think a company's stock will drop. It's at $100 now. You buy a put with a $95 strike price and pay $3. If the stock drops to $80, you sell it at $95 using your option. If the stock goes up, again, you just lose the $3 fee. Now, the expiration date is the last day you can use your option. If you don't use it by then, it becomes worthless. The closer it gets to the expiration date, the less your option is worth. That's called time decay. The strike price is the price you agree to buy or sell at if you use your option. If a call option lets you buy at $90 and the stock is worth $100, you're in the money. If the stock is only worth $80, your option is out of the money. Same idea for put options, just reversed. If the strike price is exactly the same as the stock price, it's called at the money. The premium is the fee you pay to buy the option. And when it comes to risk, traders use special terms called the Greeks. These help you understand how risky or valuable your option is. Delta tells you how the price might change if the stock price changes. Gamma tells you how fast delta changes. Theta is how time affects your option's value, time decay. Vega is how much it changes if the market gets more or less jumpy, volatility. Rho is how it reacts to interest rates. So why do people trade options? First, it helps limit your losses. The most you can lose is the premium you paid. That's much better than losing thousands on a bad stock. Second, it gives you leverage. You can make big moves with just a little money. If the stock moves your way, the gains can be huge. If not, your loss is still small and known. Let's now look at some trading strategies. Buying calls or long calls is when you think a stock will go up. Say a stock called Rocket Corp is at $50. You think it'll jump soon, so you buy a call with a $55 strike price and pay $2 premium. If it shoots up to $70, you can buy at $55, sell at $70, and make a profit of $13 per share after the premium. Or, you can just sell the option for a profit instead. Buying puts or long puts is when you think a stock will drop. Say Rocket Corp is still at $50, and you think bad news is coming. You buy a put with a $45 strike price, pay $2 premium. If it drops to $30, you sell at $45 and make a $13 profit per share. Again, you can also just sell the option itself. Now let's talk about covered calls. This is when you own a stock and you sell a call option on it. You make money from the premium and protect yourself a bit from a small price drop. Let's say you own shares of Blue Sky Technologies, trading at $100. You don't think the price will go up much soon, so you sell a call with a $110 strike price, expiring in a month, and get a $3 premium. If the stock stays below $110, you keep the shares and the premium. If it goes above, you might have to sell at $110, even if the market price is higher. So you trade higher profits for a smaller, guaranteed gain. Finally, there's the protective put strategy. It's like buying insurance for your stock. Imagine you own Green Earth Innovation stock at $150, but you're worried the price may fall. You buy a put with a $140 strike price, expiring in 3 months, and pay a $5 premium. If the stock drops to $120, you can sell at $140 and limit your loss. If the stock stays high, you only lose the $5 premium, but your investment is safe either way. So both covered calls and protective puts show how you can balance risk and reward. Covered calls help you earn extra income but limit how much you can gain. Protective puts help you avoid big losses but come at a small cost, like buying peace of mind. Now if you want the free options trading guide, just check the video description and click the link below. And please like this video so we can keep bringing you more free learning content. Don't forget to drop a comment with the next topic you'd like us to explain. We've got a lot of big stuff coming soon, so make sure you're subscribed. Thanks for watching, and I'll see you in the next episode.